Hello everyone and welcome to this video on derivatives and derivative contracts. Financial instruments known as derivatives derive their value from an underlying asset. They can be used to reduce risk, make money, or speculate on asset prices. Here is how they function. Underlying asset. A derivative's value is derived from an underlying asset, which can be a currency, such as the US dollar or the euro, a bond, an index, such as the S&P 500, a commodity, such as oil or gold, or even another derivative. The derivative's value is derived from the underlying asset, upon which it is based. Derivatives come in a variety of forms, such as forwards, futures, options, and swaps. Although each type has its own distinctive qualities, they all enable the buyer and seller to agree on a contract that details the derivative's terms. Contract details. The derivative contract includes information about the underlying asset, its quantity, the settlement date, and the contract's conditions. For instance, an oil futures contract can state that the buyer and seller have an agreement to exchange 1,000 barrels of oil at a particular price on a specific day in the future. Settlement. The process of carrying out the provisions of the contract is referred to as the settlement of a derivative. The buyer is required to pay the seller the agreed upon amount for the underlying asset when a futures contract is settled. For instance, risk management. Parties can use derivatives to manage risk by hedging against anticipated changes in the underlying asset's price. A farmer, for instance, who is concerned that the price of wheat will decline, can utilize a futures contract to sell wheat at a predetermined price, therefore effectively locking in their profit. Speculation. The price of an asset can be predicted using derivatives. To acquire oil at a predetermined price in the future, for instance, an investor can purchase a futures contract if they believe the price of oil will increase. The investor can sell the contract for a profit if the price of oil rises. Overall, derivatives can be a beneficial instrument for risk management and asset price speculation, but they can also be challenging and dangerous. Before signing a derivative contract, it's crucial to comprehend its terms and any potential hazards. When examining a derivatives contract, bear the following points in mind. The financial instrument or commodity that the derivative is based on is known as the underlying asset. It's critical to comprehend the nature of the underlying asset and the potential effects of numerous variables, such as market circumstances or economic developments. Amount. The contract-specified quantity of the underlying asset is crucial because it establishes the position's magnitude. Date of settlement. The date by which the contract's conditions must be met is known as the settlement date. This is crucial to take into account since it establishes when the derivative will expire and the transaction must be resolved. Strike price. If the derivative is an option, the strike price is the price at which the option may be exercised. The strike price of a call option is the cost at which the buyer can acquire the underlying asset. The striking price of a put option is the cost at which the buyer can dispose of the underlying asset. The premium is the sum that the derivative's buyer must pay the seller. It is usually a negligible portion of the value of the underlying asset and indicates the cost of the derivative. Credit risk. Credit risk is the possibility that the contract's counterparty may fail to fulfill their obligation. It's crucial to take the counterparty's creditworthiness into account and, if at all possible, employ a clearinghouse to help reduce this risk. Volatility. Volatility is the amount of fluctuation in the underlying asset's price. Volatility should be taken into account while examining a derivatives contract because it can have an impact on the derivative's price. Regulatory framework. It's crucial to take into account the regulatory framework in which the derivative is traded. It's crucial to be aware of these restrictions and how they could affect the contract because different nations have different laws governing derivatives. Thank you all for watching. Drop a like and subscribe if you found this interesting.